Hi everyone, welcome back to my channel. Here is part 2 on why you should invest in the stock market. I'll be going over Microsoft in this example. But before I do that, I just want to give a quick recap on part 1. So in part 1, we invested $10,000 in Apple stock at the beginning of 2008, so right before the financial crisis. So a bit of a worst case scenario. And even through that, our investment grew from $10,000 to over $100,000 at the end of 2019. Well, you might be thinking that's an anomaly. It's a one-time thing. That's why I want to show you another example by using Microsoft this time. Unlike the Apple example, I'll be going over 3 scenarios using Microsoft. So the first one will be purchasing shares at the beginning of 2008 only, so similar to the Apple video. And then in the second scenario, we'll be purchasing more shares at the end of 2008. So we'll be investing $20,000 altogether instead of just 10. And finally, in scenario 3, we'll be averaging shares purchased without adding more capital. So we won't spend the entire $10,000 at the beginning of the year. We'll be purchasing shares throughout the year. So let's get into scenario 1, purchasing shares at the beginning of 2008. So the purchase price was $35.60 and we invested $10,000, so we were able to get 281 shares. So if you look at 2009, at the end of 2009, we actually lost $1,400 roughly. And for the next 2 years after that, we still lost money. So at the end of 2011, we actually lost 27%. The following year in 2012, we actually gained 2%. So it's not quite similar to Apple where they had a big turnaround right away. Microsoft actually ended up losing money for the first 4 years. However, as I've emphasized in the previous video, had you just held your stock until 2019, it would have grew from $10,000 to almost $45,000. So you would have gone roughly 4.4x on your money, which is just great. I mean, with an extra $34,000, I mean, you could literally travel all around the world. So I just want to show you just how powerful it is to invest in stocks over the long term. Let's move on to scenario 2. So we'll be purchasing additional shares at the end of 2008. So in this scenario, we purchased shares for $10,000 at the beginning of 2008 for $35.60. And then we purchased shares again at the end of 2008 for $19.44 a share. So that gives us a purchase price of $25.50. And we purchased 795 shares in total. So our total investment was $20,000. So at the end of 2009, unlike scenario 1, our investment actually grew. We actually made $4,000. And the reason for that is that our purchase price has gotten lower because we bought those additional shares at the end of 2008. And then in 2009, the stock appreciated. So we actually made 21% that first year. And then in 2010 and 11, we actually lost a little bit of money. However, if we just held for the long term, in 2019, that stock would have been worth over $125,000 and we would have made over $100,000 in profit. And this is what happens with first-time investors. When they buy a stock for the first time and it goes down, they'll often sell it right away and they just take the loss and start saying things like, oh, the stock market isn't for me. However, experienced investors will purchase even more shares and lower the average cost per share. So in this scenario, it actually works out really well for them. They end up making over $100,000. But let's say you don't have an additional $10,000 to invest. Well, what do you do then? With that in mind, let's go to scenario 3. Okay, so in scenario 3, you still have $10,000 to invest, but instead of purchasing all the shares at the beginning of the year, you'll be buying shares throughout the year, which is usually what people do when they invest in stocks. So we'll be buying $5,000 worth of shares at $35.60. Then we'll be buying $2,500 worth of shares at $23. And finally, we'll be buying another $2,500 worth of shares at $19.44. So let's see what happens. So our purchase price, or average purchase price, is $26.47. We ended up buying 378 shares, and our total investment for the year is $10,000. So at the end of 2009, we actually had a 15% gain. As opposed to scenario 1, where we lost money the first 3 years, we actually had a gain in the first year. And then in 2010 and 11, similar to the other scenarios, we lost money. However, not as much, because we bought additional shares and we lowered our purchase price. And at the end of 2019, our $10,000 investment ended up being worth almost $60,000. So we went roughly 6x on our investment. If you remember from scenario 1, when we just purchased shares at the beginning of the year, we made about $44,000. In this scenario, we made about $15,000 more. So that just shows you how beneficial it is for someone to lower the average cost per share. Okay, before I wrap this video up, I just want to summarize each of the 3 scenarios. So scenario 2 actually ended up giving us the most return on investment at $125,000. However, I don't think this scenario is all too realistic, because I don't think most of us have just an additional $10,000 lying around to invest in at the end of the year. That's why I think scenario 3 is the most realistic. I think it's also the best and safest approach to investing, where you average the cost of shares so you don't buy everything at once. So that one ends up returning $60,000. So each scenario ends up giving you a great return on investment, no matter which one you take. And that just shows you that over the long term, stocks do appreciate and make good money. And that's everything in this video. Thanks for watching. Please like and subscribe.